Welcome everyone, and thank you for joining Mazuma USA today for our webinar. My name is Jeff, and I am a certified public accountant and tax professional here at Mazuma. At Mazuma, we are committed to helping you save time, stay on top of your finances, and have peace of mind regarding your accounting, bookkeeping, and taxes. That's why we are excited to connect with you today to share this important information. I will be taking questions at the end of my presentation, so feel free to throw your questions in the Q&A box as we go. For an overview in today's presentation, we are going to cover 5 different types of entities, business entities, along with their advantages and disadvantages. In my line of work, I often get people asking whether a partnership, LLC, or S Corp is better. They want a magic bullet, an easy answer. Unfortunately, there is no simple answer to this question. The only truthful answer I can give is it depends. Depends on your situation. Each entity has different pros and cons, which you will have to weigh for your business. Often, it can be helpful to walk through these benefits with an accountant or financial advisor who knows your particular situation. So if you have questions at the end of this presentation, feel free to reach out to our team. We'd love to set up a meeting and see how we can help. But for now, we have a lot to cover, so let's dive in. First on our list is a sole proprietorship. Many small business owners form a sole proprietorship when they are starting out. It's one of the simplest and less expensive entities to form because no legal paperwork is needed to form a sole proprietorship. However, your city or state may require you to obtain a business license, and you will want to register your business name with your state. If you are a sole proprietorship, this means that you own and operate the business by yourself. You have complete control. All the profits of the business are yours. But it also means you are responsible for all the losses and the debts. That is one of the main drawbacks of being a sole proprietor. No liability protection. This means if any legal issue arises, you will be held personally responsible for, and those debts will need to be paid from your personal account. When it comes to business taxes, filing is quick and easy. You can file your business taxes with your individual tax return by using a Schedule C form. In addition, you can deduct expenses and losses from your business against any other income you might earn, which will lower your tax bill overall. The one drawback about taxes for sole proprietor is that you are expected to pay a 15% self-employment tax. This is covering Social Security and Medicare taxes. You are also required to pay estimated quarterly taxes throughout the year. These payments are usually due April 15th, June 15th, September 15th, and January 15th. If you don't pay estimated taxes quarterly, you may have to pay a penalty and interest on what you owe, but the fee is relatively low, only 0.5% of the taxes owed. But still, it's smart to get into the practice of paying quarterly estimated taxes on time. So overall, the advantages of forming a sole proprietorship are that it is less expensive entity to form, you have complete control of your business, and tax preparation is quick and easy. The biggest disadvantage is no liability protection. Now let's look at a general partnership. A general partnership is simple to form. Like a sole proprietorship, your city or state may require you to obtain a business license, and you will want to register your business name with your state. I'd also recommend that you set up an operating agreement, since now you have multiple partners, multiple people involved in your business. So with the operating agreement, you know, what are the different roles and responsibilities, what percentage of the profits will you share. Laying this out at the start will make the operation of your business smoother in the long run. Like a sole proprietorship, a general partnership does not give you any liability protection. This means each partner in the business is personally responsible for any debts or legal action. In addition, general partnerships are required to pay the 15% self-employment tax as well as quarterly estimated tax payments. However, as a partnership, you have a lot of flexibility and can deduct any losses in your business against other income to lower your taxes. But that's where the similarities between a general partnership and a sole proprietorship end. In a partnership, you file a partnership tax return every year. That is a Form 1065. Then each partner is given a Schedule K-1 showing their individual share of the profits and losses based on your agreement. That means you will need to file a form as a partnership as well as your personal tax return. So there'll be two tax returns that go along with it. Another potential problem for a general partnership is sharing control between multiple people, which can create conflicts and complexity. Now let's look at the pros and cons of a single member LLC. A limited liability corporation, or LLC, is a little more expensive to form. An LLC must be registered in the state where it does business. Each state varies slightly, but most require you to choose a distinct name and to file articles of organization. Many states charge a filing fee for the articles of organization. These articles of organization include information like your business name, address, and names of the members. For most states, you file with the Secretary of State. However, other states may require you to file with a different office. So carefully check the requirements in your state. But an LLC offers liability protection that a sole proprietorship or general partnership does not. It allows you to separate your business assets from your personal assets, which means if your business is sued or runs into financial trouble, the business will be responsible to pay and not you personally. In addition, with a single member LLC, you have complete control and flexibility. All profits of the business are yours. And you can deduct any losses in your business against other income to lower your tax bill. However, you will need to pay self-employment tax to cover Social Security and Medicare taxes, as well as estimated quarterly tax payments. You also can choose whether to be taxed as a sole proprietorship or as an S corporation, whichever works best for your business. This provides a great balance between liability protection and business flexibility. A multi-member LLC has quite a few similarities with a single member LLC. For example, you get the same liability protection, which means your business and personal assets are separate. You also go through the same formation process and file documents with your state. And you will be required to pay Social Security and Medicare taxes, as well as estimated quarterly tax payments. Also, you can deduct losses against other income and elect to be taxed as an S corporation. These differences revolve around the complexities of having multiple members involved. Because of this, you cannot elect to be taxed as a sole proprietorship, because a sole proprietorship is only for one member. In addition, there are some complications that arise with sharing control of the business. Like a general partnership, you will want an operating agreement that outlines everyone's share of the profits and losses. Each person in your LLC will then pay taxes based on their specific share. your LLC would file a Form 1065, and then each partner will fill out a Schedule E on their personal tax return. Okay, the last entity we will be discussing today is an S corporation. S corps have the benefits of a corporation but are taxed as a partnership. Like a LLC, an S corp separates business owners and their assets from the business. Creditors can only go after the business but can't touch the business owner's personal assets to pay debts or litigation. Establishing an S corp takes a lot more than an LLC. There's a lot of paperwork involved. Most S corps spend a considerable amount in attorney and accounting fees. An S corp also requires more maintenance. You must develop a board and bylaws, issue stock, hold board meetings, records of each board meeting. The IRS also has the following requirements for S corporations. All shareholders must be US citizens. You cannot have more than 100 shareholders, and you can only have one class of stock. The taxation of an S corp is what sets it apart from other business entities. When you have an S corp, you don't have to pay taxes for self-employment tax. Any shareholder who works with the company must be paid a reasonable wage. After their wages are paid, the rest of the net income from the business is passed on to the shareholders as dividends, and those dividends are not subject to self-employment tax. But this also requires you to set up payroll for the owners and employees because they have to take that reasonable wage. You also have limitations on deducting losses from your income and no flexibility when it comes to income allocation or distribution. In addition, the laws for S corporations are not the same in each state, so you will want to look into individual requirements for your state. So which entity works best for your business? As you can see, there is no simple answer. Depending on your business, your industry, the structure, and revenue, and also what your plans are for the future, might outweigh some of the advantages or disadvantages. And what entity works best for your business might change as your business grows. So the best advice I can provide is to know these pros and cons and then make an informed decision. Get expert advice. As you start out, it might be simple to see which entity works for your situation, but things can get more complicated as you grow, as your business keeps transforming. Have an informed discussion with an accountant or financial advisor who can provide advice based on your finances and business size. These can have a significant impact on your business. So make informed decisions. If your situation is complicated, paying extra for expert insights will pay off in the long run. And these types of discussions are ones we love to have with our clients.